The relationship between the US dollar and gold has been dynamic, influenced by historical events, economic policies, and global financial conditions. Here's a deeper dive into their interplay, along with some historical examples. 1. The Gold Standard Era, 1870s–1933. 1. Context. Under the gold standard, the value of the US dollar was directly tied to a fixed amount of gold. 1. This meant that the strength of the dollar was equivalent to the strength of gold, as both were interchangeable. 2. Historical example. In 1933, during the Great Depression, President Franklin D. Roosevelt ended the convertibility of the US dollar to gold for private citizens, which marked the beginning of the end for the gold standard. 2. This decision was aimed at combating deflation and stimulating economic growth by increasing the money supply. 2. Bretton Woods System, 1944–1971. 1. Context. After World War II, the Bretton Woods Agreement established a new monetary system where the US dollar was pegged to gold at $35 per ounce, and other currencies were pegged to the US dollar. 1. This system made the US dollar the world's primary reserve currency. 2. Historical example. By the late 1960s, increasing US government spending, particularly due to the Vietnam War, led to concerns about the US's ability to maintain the gold standard. 2. This culminated in the Nixon shock of 1971, when President Richard Nixon suspended the dollar's convertibility into gold, effectively ending the Bretton Woods system. 2. This led to a floating exchange rate system and allowed gold to freely trade on the open market. 3. Post-Bretton Woods, 1971–present. 1. Context. After 1971, the US dollar was no longer backed by gold, leading to significant fluctuations in its value against gold. 1. The price of gold has since been influenced by various factors, including inflation, interest rates, and global economic stability. 2. Historical example. In the 1970s, the U.S. experienced stagflation, high inflation combined with economic stagnation. 2. As inflation eroded the dollar's value, gold prices soared, reaching an all-time high of $850 per ounce in January 1980. 2. Investors turned to gold as a hedge against inflation, demonstrating its strength relative to the weakening dollar. 3. Historical example. During the 2008 global financial crisis, the US dollar initially strengthened due to its status as a safe haven. 3. However, as central banks worldwide, including the Federal Reserve, implemented expansive monetary policies, e.g., lowering interest rates and quantitative easing, concerns about inflation and the value of fiat currencies led to a significant rise in gold prices. 3. Gold reached a peak of around $1,900 per ounce in 2011. 4. Recent trends, 2010s–2020s. 1. Context. In the 2010s, the US dollar remained relatively strong due to the country's economic recovery post-2008 crisis and the Fed's interest rate policies. 1. However, geopolitical tensions, trade wars, and economic uncertainties continue to support gold as a safe haven. 2. Historical example. The COVID-19 pandemic in 2020 led to unprecedented economic uncertainty. 2. Central banks, including the Federal Reserve, responded with massive stimulus packages, which raised concerns about inflation and the long-term strength of fiat currencies. 2. Consequently, gold prices surged, reaching a new record high of over $2,070 per ounce in August 2020, while the US dollar experienced volatility. 5. Comparative strength. 1. Inflation and fiat currency devaluation. Historically, the US dollar, like other fiat currencies, tends to lose purchasing power over time due to inflation. 1. For example, what $1 could buy in 1970 costs much more today, reflecting the dollar's depreciation. 1. In contrast, gold has maintained its purchasing power over long periods, making it a hedge against inflation. 2. Global economic crises. During periods of economic turmoil or crisis, gold often strengthens relative to the dollar. 2. Investors flock to gold as a safe haven asset, while the dollar may weaken if confidence in the U.S. economy or fiscal policy wanes. 6. Current dynamics. 1. Rising interest rates. As of the 2020s, the U.S. Federal Reserve has been raising interest rates to combat inflation. 1. Higher interest rates tend to strengthen the dollar because they attract foreign investment seeking higher returns. 1. However, if inflation persists or geopolitical tensions escalate, gold may again outperform the dollar as a safe haven. 2. Digital gold and cryptocurrency. In recent years, Bitcoin and other cryptocurrencies have been compared to digital gold, offering an alternative store of value. 2. However, gold remains a trusted asset due to its long history, whereas the U.S. dollar continues to dominate global trade and finance. Conclusion: the relative strength of the U.S. dollar and gold fluctuates based on economic conditions, monetary policies, and global events. Gold is often seen as a stable store of value and a hedge against inflation, especially during times of economic uncertainty or when confidence in fiat currencies, including the U.S. dollar, is low. Conversely, the U.S. dollar remains strong during periods of economic stability and rising interest rates, benefiting from its status as the world's primary reserve currency. Understanding the historical context and current economic environment can help investors and observers make informed decisions about when to favor one over the other.